10 top year-end tax tips. Start tax planning now, and you could owe the government less in the spring, says Mary Aileen LaPonce from U.S. News. So let's read what this is. Interesting here. This is off U.S. News, Dateline November 11th, 2019. Don't put that pen in your mouth, sister. It might have lots of germs on there. Don't put that pen in your mouth. All right, so with the winter holidays looming, the clock is ticking for taxpayers who want to minimize what they'll be paying. There are very few tax-saving things that we can do after the start of the year, says Ed Zollers, a CPA, an instructor with Kaplan Professional Education. Most tax tips need to be implemented by December 31st to have an effect on tax filing this spring. By tax planning now, you won't have to rush through the process later on, says Ed. Get starting by using these 10 tax tips to beef up your savings and minimize the amount of federal income tax you'll pay in 2019. All right. It looks like they put them all in order. That's kind of cool. So you don't have to click through each and every one. But let's read them. So make 401k, HSA contributions. Avoid taxes on an RMD with a charitable donation. Hold off on mutual fund. Oh, yes, that's a good one. I got the Vanguard just emailed me what their expected capital gains are. I'll do that in one next. Actually, hold off on mutual fund purchases. Do not buy the dividends. Stay to my next video. I'm going to do that on the Vanguard projected distributions for it. Don't buy the dividend. Oh, this is nuts. You got to understand that. Harvest your capital losses. Talking to a guy yesterday, my man Mike, and he had a loss in the Vanguard Energy Fund. It wasn't a huge amount, but like $1,100, $1,200. And we're like, might as well just sell it. Come back and pick it up in 31 days for sure. He had a loss in, initially had a loss in Boeing, but that's since price backed up. So it wasn't very much, like $50. It wasn't worth it. So there wasn't much out there, my friends, for capital loss harvesting for sure. Pick up capital gains. This is, it's actually interesting that I didn't realize I was going to say it. It's just 100% right. Pick up capital gains if you're in a low tax bracket. Remember, if you remain in the 12 and 10% tax bracket, you have no capital gain, no tax due on long-term capital gains or qualified dividends. But you have to remain in the 10 and 12 tax bracket. If it puts you above the next one, you do have to pay tax. So many people get this wrong. They think, oh, I got $500,000 of long-term capital gains and no other income. Thus, I don't have to pay taxes because they think capital gains, long-term capital gains, as long as you don't have the 22% tax bracket, they're tax-free. Well, that will put you in the 22% tax bracket. Maybe I'll do a right. Actually, let's do a right capital on that, shall we? Hold on just a second. Look at old Matt and Mary married. Matt and Mary married, all right? And we're going to go and we're going to say they have, buddy. We got profile. They got $1 million. And they have it all. Okay, cool. We're just going to put their cost basis as 0. And we're going to have to say they have no other income. All right. And we're going to have, hold on just a second. Try now. There we go. And we're going to say they have a goal. They need $1 million or they need $500,000 to live. All right. So that will generate a pretty significant tax hit. All right. There we go. So let's see what we got here. We're going to hit tax. And it should be pretty high, as you can tell. Yeah, right there. All right. So let's look at what the 1040 looks like, shall we? So that's, we'll just show the cash flow here. Old Pablo's running around like a chicken with his head cut off. So we're going to look at cash flows. And I'll explain what we've done here. So we got income flows nothing. We got tax payment of $228,000. And that's federal taxes. We click on that. Adjusted total income 1.13 million, taxable income 1.06, tax they're paying 189,000, other taxes 33,000, and so there's this is sweet. I didn't know they did this. They give you the total income, adjusted gross income deduction. Oh man, I didn't know they did. This is new. Right Capital, I love you. Will you marry me, Right Capital? Again, this is personal exemption right there. They changed. I love Right Capital. Right Capital, marry me. Anyway, so what we'll see, let's go down to accounts, and we're going to hit ending balance, withdrawals from accounts, taxable account. Oh, it's I got to go up here, 2020. Oops. Hold on just a second. There we go. 2020. There we go. So they have a taxable withdrawal of 1.051 million because they're going to sell the money they need to live on, if that makes sense. So they're going to, that's what's happening here. They're going to sell their whole position. They have no capital gain basis, thus they're going to pay tax on that money. So if we go to the tax, we hit details here. And what we'll see here, here's their adjusted gross income, 1.13 million. They had some interest in that account. At this stage, I don't care. But their adjusted gross income is 1.13, all right? And so what happens is we take our 1.13, subtract our standard deduction. That's our 1.1 million in total income. That's their taxable income, and they're going to have 22.8% effective tax rate. Pablo, he's walking behind the computer. You don't get much more entertainment than old Pablo, do you? So let's look at what the 1040 looks like, the schedules. So again, we have a pretty significant tax hit, even though they don't have any other income whatsoever. They're still in, theoretically a 0% tax bracket, or even a 10% tax bracket. But because this is one long-term capital gain, they have to pay tax on that. So let me show you the schedules here. Go to Schedule D, capital gains and losses. Here's their short term right here, 110, and here's their long term, $991,000. And then we go to Schedule 1, Schedule 1 right here. And what you'll see is here is capital gain, 1.1 million. So their whole income is from capital gain, except for the other small amount of dividends and taxable interest. So there you go. That will prove to you once and for all that you have to pay taxes on your capital gain if that puts you above beyond the 10 to 12% tax bracket. So let's see what else they got. So anyway, so now on the other hand, let's say you had a capital gain. Let's go back. Let's do it again. This will be fun. All right. So now maybe I can try some here. So we're gonna hit profile. We're gonna say let's create a new investment. We're gonna say let's just do this. We'll say we have 100 shares. What will that give us? Oops. So that'll give us, let's say we have we'll say we have 10,000 shares. Yeah, there we go. And I don't want 10,000, we'll say 5,000 shares. I'll say 1,500 shares, there we go, right? What will that give us? There we go, 1,500 shares, all right, cool. And we have a cost basis of, we're going to say a cost basis of $15,000. All right. And we're going to go to income, and we need $41,000. We got to go to goals, and we're just going to get rid of this. And we're going to need $40,000 to live on. All right. So we need $40,000 to live on. Nope. Do not bite the wire. No. Good boy. So let's see what the tax would be. Nothing, right? Because we had to sell that $40,000 stock, but we had a $15,000 cost basis. So because we have no other income, we're still in the 0 or to 10 to 12% category. If we go to retirement, oh, you like that? He's sitting in the. I got these new lights, and they're kind of hot. He's sitting and getting shined on it. I guess he likes the heat from that. So we go to cash flows. Good boy, Pablo. We're going to go to cash flows, and you'll see what we'll have here. Go to accounts, go to withdrawals from accounts, and we have the taxable income right there as income taxable because we're taking our money from that account. So we sold $42,000, basically $43,000 to pay for our income needs. Now if we go to tax, let's see. I don't think that'll be it, right? Yeah, for the taxable. So if we go to, where do I want to go? I want to go summary, excuse me. Summary. Tax payment, nothing. No capital gain, no total tax payment, nothing. And if we go to the tax form, 1040, we'll see we have $30,000 of total income because we had a capital gain of about $30,000. So we sold the stock. We had a capital gain of we had $45,000 value. $15,000 was our cost basis. $30,000 was the capital gain, and we have no taxable income, even though it says 30,000 there taxable income, but it's not, because it's on the Schedule D from long-term capital gain. And so because it's long-term capital gain right there, 25,000, and then short-term, well, in this case it doesn't really matter because we have enough standard deduction to offset it. But either way, you'll see here's our capital gain, 25,945. If you just go to Schedule 1, there's our total capital gain, 28,828. If we go back to the 1040, right here, put that on, project it over to total income right there, it's all tax-free because we're still in the 10 or 12% tax bracket because that long-term capital gains are tax-free. Essentially, that's what they're saying for our taxable income, which is the 2883 from the short-term capital gain plus his taxable interest. But again, because our standard deduction, East Side Alive, is tax-free. So we have $40,000 of income, $45,000 of income, of which $30,000 is a long and short-term capital gain. $3,000 is roughly short-term, $25,000 is long-term. The $3,000 short-term goes down to the bottom line, but it gets eaten alive by our standard deduction. So we have no taxable income whatsoever. And then we have 12%. We're still in the 12% or lower tax bracket, so it's all tax-free. So that's so anyway, going back to what these guys say, pick up capital gains if you're in a low tax bracket. 100% agree with that. That's if you're going to be in a low tax bracket, you got a stock maybe you're too heavy in, you want to take some gains off the table, do that. Invest in qualified opportunity zones. I'm not all that familiar with that. It sounds okay. I don't know. A bunch of charitable contributions. I completely agree with that. If you're going to be making large gifts, don't put them out one by one because it might your standard deduction might eliminate your ability to itemize. So let's say you're going to give $50,000 to your church, right? And you say, I'll give $25,000 this year and $25,000 next. You might not want to do that. You might just want to give $50,000 one year so you can itemize the whole thing and deduct it. Use your flexible spending account balance. Yeah, use it or lose it. And again, of course, contribute to your HSA as well. So lots going on there. Pretty good article. Actually, I didn't really read it that much, but we can read what they say here. And I'll put a link in the show notes. But I'm a big fan. And again, Right Capital is doing right by me, man. They're really picking it up. I could not be happier with what they're doing here. Where do I want to go? Oh yeah, from the cash flow. It'll tell you exactly what your tax breakdown is. I think that's fantastic. So, all right, we'll see you next time. Thanks, guys.